Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Market Site studio in Times Square, New York City, we have Max Cabasso. He's managing director on Nasdaq's Market Intelligence Desk for an update on technical levels to watch in the Nasdaq 100. We'll also cover some macro as well. Max, it's great to see you as always. Welcome back to Trade Talks. And it's 2023 has really started off with a lot going on in the market. We had a strong first quarter with the stocks that did not do well in 2022, and that seemed to have reversed fortune already this first week of trade in April.
Yeah, absolutely. The first quarter was outperformance of the large caps versus small caps. But again, numbers that came out this week. We had OPEC cutting the numbers this week. JOLTS data came out below 10 million for the first time in a while. Costco numbers came out, last night. They were a weaker sale, so. It's been an interesting start, to say the least. I actually was talking to one of our issuers yesterday in the semiconductor space, and they had their best quarter, semi's best quarter in almost 20 years. And he mentioned to me, he's like, it really didn't feel like that at all. It did not feel like we had this great gangbusters quarter. I said, well, you know what? That's the benefits of starting essentially at the lows to start the year. We were at the lows of last year. So although we had this great start to the year, it really didn't feel that good because you're kind of just getting back to treading water.
Let's talk about technical levels to watch in the Nasdaq 100 because you have a chart of us to see there, but then you also compared it to the broader Nasdaq Comp Index.
Yeah, so Nasdaq 100 has been performing, obviously pretty well. We have some room to the upside. We got through the June highs, the previous June highs. So upside, we're at that 13,667 level. Downside really of about 12,900 down to just under 12,800. But again, that's in comparison to the total composite, which was unable to get through those previous June highs. So now we're sitting with a lot more resistance to the upside for the composite versus the 100 where we really have a lot more room to the upside. And again, I think the outperformance so far this year, 100 to the composite is about 4%. When you actually compare that to like the Russell 2000, it's closer to 19% just to start this year. So obviously it's a huge divergence. The mega caps have again beat up last year. It's kind of that flight to quality, flight to safety, and you're really seeing that divergence here where large caps are getting everything and the small caps are really taking a punishing.
Right. Well, also the Nasdaq 100 doesn't have bank exposure or that small cap exposure. Speaking of the banks, let's take a look at your next chart here because kicking off earnings season next week are the big banks.
Yeah, obviously really beaten up here to start. We have some support really at the 2018 lows down to 2000 for the regional banking index. Below that, though, is really the COVID lows, which is another 500-point drop. So kind of in a bit of a no man's land at this point. Obviously, we saw a lot of the bloodshed to start, when we had the crisis. But we're starting to see, some of the talk turning. It's constructive. It's more positive that everything's kind of is baked in. But the questions that I have when I was reading earlier, it's like you can't really have a partial crisis. There's either a banking crisis or there's not. And we've seen, obviously, rates expectations crumble because of the expectation that there's a banking crisis. So if there is a banking crisis, the Fed's probably going to have to cut more aggressive. And if there's not, obviously we have non-farm payrolls numbers coming out tomorrow. If that number's hot and the inflation narrative kind of stays where it is, I think the risk is to the upside that they're going to continue to step on the gas, and that's not really going to help those regional banks that are really looking for those cuts right now because obviously they're having dislocation duration. So I think there's a bit of a disconnect and there's not much conviction. But again, you can't really have a half of a crisis. And, and I know we're going to talk about.
But I just want to make the point here. I don't think we're going to see those 2, 3, 4 rate cuts this year. They are not going to shift policy that quickly. They don't want to make mistakes. If you look at the past in the 70s and 80s, and they've been clear about that. But what are your thoughts on Fed fund rates and also jobs? Because we are seeing the economic data come in. Jobs are starting to give the Fed what they want.
Right, it's giving the Fed what they want, but I don't think we're there yet. And again, when you look even just a month ago to what we were looking at in terms of Fed expectations, it was, okay, we're going to stay higher for longer, a couple more rate hikes, and then stay flat. And now we're pricing in, by the end of the year, I think of 3.5 cuts. And again, that was based on the assumption that we had a real banking crisis. And if that's not the case, I am in agreement with you that I find it hard to believe that the Fed's going to take their foot off the gas that quickly, that where this whole thing was based on that information. If that's not really there and they're just looking at economic numbers, potentially they'll, again, just kind of stay flat versus, continuing to hike. But I tend to agree there's a big dislocation with what the Fed's saying and what the bond market is pricing in right now, which again now turns to tomorrow to NFP numbers. If those numbers come in above what we're expecting, that's when I think you're going to see, again, obviously we're off tomorrow, but you could see a bit of a nasty reaction to it where stocks aren't going to like it and bonds, you're probably going to have to start pricing in. We're not going to get as many of those cuts. So I think there's that risk to the upside there. And again, we had the numbers come out this morning, but there was revisions last week of unemployment numbers, so revised up. So these numbers were actually a drop from previous numbers, but again, they're starting to get what they want to see. But again, I'd be very surprised if they really cut like the bond market is pricing in right now. So there's a big dislocation between the two.
I mean, even though JOLTS came in at 9.93 million, it's still almost 10 million. But that's what's so crazy with this market when you look at it from a fundamental or technical perspective. It could be this, it could be that. Volatility is relatively low.
Yeah.
Bond markets are pricing in a recession. Equity markets haven't figured that out yet. So what's going to be the deciding factor here?
I think it would have to be a decisive number for a number of data sets that show we are in a recession or we're not. Anybody I talk to right now, I have a close friend at a futures desk, and he continues to say week over week, there's no conviction, there's no conviction, there's no nobody is, because nobody can decide is good news or is good news bad news. For a while we knew, okay, if we have bad news or if there's bad news, okay, Fed's going to stay light, money's cheap. We don't know anymore. You see these reactions when these numbers come out, you'll see the futures move higher, and then wait a second, maybe bad news actually is bad news, and it comes off. Then we have these kind of flat days where we're moving, but then by the end of the week, you're like, wait a second, we're kind of back to where we've been. So I think it's going to take consecutive numbers that are all pointing in one direction, that, okay, inflation's coming in and the market's holding up, or jobs numbers really crater, there's weakness across the board, GDP is starting to fall. Until I think there's consecutive data sets like that, I feel like we're going to kind of continue to tread water and move sideways. Again, there's really no conviction. Nobody wants to put money to work, and nobody can decide is good good or is bad good.
Well, I guess the moral of the story is here, if you're a longer-term investor, because time frame means everything.
Yes, for sure.
You can't time the market. What if you tried doing that from 2020 and all these opportunities that we had, the dips and the bounces? Stay invested, stay diversified. Right. So there is something in there for the longer-term investor.
Of course. Long-term, it's much easier. Again, trying to pick tops and bottoms, you'll get chewed up left and right. Long term, you're going to be better being involved. Again, because you don't know when it's going to turn, when it's not going to turn. I remember after the COVID lows, the narrative was always, we're going to retest, we're going to retest, we're going to retest the lows. Never happened. So if you were sitting there waiting, okay, here it comes, we're going to retest the lows, we have to retest, you missed the entire move higher that we had for 2 years. So maybe you'll get smart one time, or it'll work out and we do test the lows again, you have another opportunity, but there's a good chance that you'll miss out. So.
And that was one of the best opportunities of our lifetime.
Of a lifetime.
Right. All right. Appreciate the insight as always, Max. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.